Hi, everyone. Welcome to today's program on deal sourcing. My name is David Toll. I'm the publisher of Private Equity Career News, and I'll be your impresario for today's program. You've managed to join a little early. We're going to start in about 5 minutes with the formal program, but I wanted to reward your punctuality with a few tips on how to make the most of the program. And also maybe time permitting, we'll get a few personal insights into how our speakers spend their spare time outside of work. So to make the most of the program, go to your control panel and you should see a handout section. Go ahead and download a copy of the presentation from today's slides. At the same time, you can also download a really cool report which has results of a survey of business development professionals, gives you some insights into best practices across the industry when it comes to deal sourcing. Beyond that, we have a question feature also on the control panel. Please feel free to ask questions at any time during the program, and we'll try to field them either then as you ask them, or we'll save it for the end of the program when we have a formal Q&A. So again, thanks for joining us a little bit early. I thought it would be nice to hear from some of our panelists how they spend their time outside of work. Why don't we start with Paul Lipson of 4 Point Capital up in Boston. Paul, what are some things you do outside of work to relax and enjoy yourself?
Hey, David, thanks so much. So I have, as I know some other folks on this panel do as well, I have relatively young kids. And so I found it as much as I can coerce, coax, and trick my children doing the stuff I like. I get to spend time with them and do those activities. So that wherever possible is skiing and fishing. So in any order in all the seasons. So that's how I do. That's how I spend my time if I can. Not on great panels when I'm not on great.
All right, thank you, and thanks everyone who's joined us a little early here. We're hoping to reward you with some insights into how our panelists spend time outside of work. Let's go to Brendan Burke out in Denver. Brendan, what are some ways you unwind outside of work?
Well, like Paul, I also have young kids, and so there's really not much unwinding happening these days in my house. I have a 9-year-old son, but we live at the beach, so when the weather's nice, I spend most of my weekends trying to cajole my family to getting down to the water, and we really enjoy that, especially this time of year. It's sort of perfect down where we are in Virginia.
Nice. I think I said Denver. Where are you located, Brendan?
We live in Virginia Beach.
Awesome. Michael, let's turn to you. How do you spend your time, spare time outside of work?
Yeah. Thanks, David.
Hobbies?
No hidden talents, unfortunately, but I'd say similar to Paul and Brendan, 2 young children living on a coastal town in Connecticut. So we try to do the beach on the weekends. They're busy with soccer, and I'd say this past year I've been spending a lot of time converting both my children into New York Mets fans, and it was a fun ride while it lasted. Let's put it that way. So unfortunately, hopefully they're not cursed for the rest of their lives, but it was a fun end of season, and we got to attend a couple games in the NLDS series, so that was fun. It was their first baseball game, first time to Citi Field. It's quite an experience.
Nice. Yeah. Well, if they don't become fans this season, I don't know that they'll ever become fans, Michael.
Exactly.
A great season. And thanks everyone for joining early. We're just bantering a bit before we start the formal program. Nadim, how do you spend your time outside of work?
Well, one of my hobbies, David, is the guitar. It's something I picked up as an adult about 8 or so years ago when my eldest son started taking guitar lessons. I thought it'd be something we could do together, and we've both stuck with it. And I even took it so far as to do a few open mic nights, which is very, very nerve-wracking to perform in public, to sing in public. And after doing a bunch, no one came up to me afterwards and said, you got it, Nadim. You can quit your day job and this is your life. So I keep it at a hobby level for the benefit of everyone.
Okay. Any performances coming up that we should all go to?
No public performances in a bit. I think it's more just for myself now.
All right. Well, thank you, speakers, for giving us some insights into how you spend your time outside of work. We're going to get going with the formal program right now. So good morning to everybody. Welcome to a special Private Equity Career News webinar, Correcting Course, Emerging Opportunities in 2025 Deal Flow. My name is David Toll. I'm the publisher of Private Equity Career News, and I'll be your impresario for the program today. I'd like to start out thanking our sponsor, SBS by Bain & Company. They're a wonderful company. It's an award-winning provider of actionable data and analytics for private equity firms to help optimize their deal sourcing efforts. I have a few housekeeping announcements to make before we really get into it. First, a friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you would like to use anything that they say today in an article. Second, you can download a copy of the slide presentation from your control panel. You can also download a copy of the results of a 2023 survey that we conducted of business development professionals. Lots of great information in there on industry deal sourcing practices. Third, later today, I will send you a recording of the program, so no need to take extensive notes unless you really want to do that. And finally, many of you, as you registered for this program, you asked some really good questions. We will plan to address those during the roundtable discussion portion of the webinar. Please, though, also feel free to ask questions at any time. You have a question feature on your control panel, and I'll be monitoring those during the program. If you don't hear us address it right away, we are most likely saving it for the last 15 minutes or so. Okay, those are the housekeeping announcements, and I'm super grateful to have 4 expert speakers today to guide you through the topic. Brendan Burke in Virginia Beach is Managing Director and Head of Financial Sponsor Coverage at investment bank Capstone Partners. We have a deal sponsor, Paul Lipson, the Boston-based co-founder and partner at private equity firm Fort Point Capital. Here in New York City, we have Michael Morabito. He's Managing Director at investment bank Houlihan Lokey. And we have Nadim Malik. Nadim is founder and CEO of New York City-based SBS by Bain & Company. After some brief introductions of the speakers, Nadim will present statistics showcasing the state of the M&A market and also addressing the role that technology plays in helping deal originators see a higher percentage of relevant transactions. So with that, let's find out a little bit more about our speakers. Briefly, Brendan, tell us more about Capstone Partners and the role that you play there.
Sure thing. Capstone is a middle market oriented investment banking firm. We're just over 200 people, headquartered out of Boston and Denver. Pretty typical suite of investment banking products, buy side and sell side M&A, a debt capital advisory practice, minority equity capital formation and infrastructure finance group, and then a transaction services practice. And we are a subsidiary of Huntington Bank, which is a Columbus, Ohio-based commercial banking firm.
Thanks, Brendan. We're glad to have you on the program. And Paul, tell us a little bit more about Fort Point Capital and your role there.
Thanks, David. As you said, my name is Paul Lipson. I'm a partner at a Boston-based private equity fund called Fort Point Capital. We're currently investing out of our third fund, which is $350 million in size, and we use that capital to acquire control positions in nicely growing business-to-business services companies anywhere in the U.S. or Canada. So all control and leverage buyouts all over this land.
All right, thanks, Paul. It's great to have a deal sponsor on the program. And Michael, tell us a little bit more about Houlihan Lokey and what you do there.
Sure, absolutely, David. Thank you. So Houlihan is a leading mid-market investment banking and advisory platform with approximately 2,000 employees across 36 offices globally. We went public about 10 years ago. Market cap now stands at about 12 billion. We are one of the most active M&A advisors globally, closing a transaction approximately every 48 hours. In addition to our M&A capabilities, we also have one of the largest and most robust valuation practices, as well as one of the most, I'd say, active and notorious financial restructuring practices, which hopefully no one on this line will ever need to use or call, but we do have that capability. I've been with the firm 20 years, career investment banker, sit within our industrials group, part of our broader industrial tech and services practice, and focus specifically in and around safety and security businesses.
Okay, very cool. Every 48 hours, close a deal. So that's pretty prolific. All right, let's turn it over to Nadim Malik of SBS by Bain & Company. Nadim is also going to introduce himself and then go through a short presentation shedding light on the current state of the M&A market. Nadim?
Thanks, David, and thanks everyone for joining us today. I'm Nadim. I'm founder and CEO of SPS by Bain & Company. For those of you in the Northeast, hope everyone's enjoying some beautiful fall weather. At SPS, we're continuing to do what we do best, which is helping our clients position themselves for relevant deal sourcing opportunities in the current or frankly any market based on data analytics, technology, and automation. So, though the surge of deal activity that people have alluded to and many are waiting for has not yet materialized, deal activity in the private equity and M&A world is up, though be it slightly. And with interest rates on the decline, inflation in check, and a soon-to-be election behind us in a few weeks, let's hope, are we now on the cusp of that long-anticipated surge of deal activity? Well, I'm really looking forward to hearing the perspective of our panelists who are great at what they do and have been doing it for a while, each of them grappling with many of the same questions as our audience. And before turning things over to them, I wanted to spend the next 10 minutes or so walking through some slides to help frame our conversation, starting with what David has pulled up in front of the screen right now, which is total private equity and M&A deal volume. So 2024 deal volume is on pace with 2023 levels. Deals completed in the first 3 quarters, as a matter of fact, are exactly 75% of deal volume for the full year 2023. Now, having said that, due to data lag, since we're already at a 75% of last year's level, I think it's safe to say this year will be higher than last year, but more to come on that. As a reminder, despite the 16% decline in deal activity year over year in 2023, it was still the 3rd most active year since we started tracking the data and well above pre-COVID levels. If 2024 does indeed end up outpacing 2023, it really looks like we're bottoming out and poised for growth in the coming years. On a final note, PE buyers have outpaced corporate buyers so far this year, having completed 52% of the overall deals. Let's look at the quarterly numbers on the next slide. Now that the picture on Q2 24 deal volume is more complete, We can see that activity in Q2 was more or less right in line with Q1 and well above Q2 2023, which is a very positive trend. Also, Q3 numbers are already almost in line with Q3 2023 numbers, and once the data lag effect is behind us, we'll end up coming in higher than last year as well, suggesting a positive trend year over year for 2024 deal volume, provided we see the usual bump in closed deal activity in the fourth quarter. My final comment on this slide is that if you look at the last 7 quarters, you can see how much the deal activity has essentially stabilized and started to gradually increase when compared to that tumultuous down, up, down roller coaster of deal activity that was 2020 to early 2022. Moving on to the next slide. Here's a look at the most active sectors for the first 3 quarters of 2024 compared to 2023, broken out between strategic and PE deals. Industrials has been the most active sector and is up slightly compared to last year, but that growth has been driven by corporate M&A activity. PE deals are actually slightly down year over year. Technology and business services are the second and third most active sectors, respectively, with material increases in both PE and corporate deal activity. Interestingly, healthcare, financial services, energy, and media telecom are all down slightly through the first 3 quarters. Also, private equity has the edge over corporate buyers in 4 of the top 5 most active verticals, with consumer being the exception where corporate deals outpace private equity. On a final note on this slide, in the financial services space, where historically corporate deal activity has had a solid edge over private equity, that trend has reversed so far in 2024. Moving on to the next slide, this shows the trend of the buy and build and roll-up strategies in private equity, which continues to accelerate. It reached 2.7 add-ons for every platform in the first 3 quarters of 2024, compared to 2.5 add-ons for every platform in the prior 2 years, and 1.4 add-on per platform about a decade ago, so almost doubling in that time. I'm really curious to see if we'll ever surpass 3 add-ons for every buyout or even 4. At this point, I think most PE firms have caught up on this trend, and it's really hard to ignore, and we're certainly seeing an increasing focus on it on the deal sourcing side with our clients. Moving on to the next slide, looking at private equity activity only, and breaking down the sectors by the 4 deal types we track, which are add-ons, buyouts, recaps, and financings, which is what we call non-change of control transactions. Industrials, business services, and financial services saw the greatest add-on activity relative to other deal types for the first 3 quarters of the year, while financings continue to remain an important investment strategy in the technology space. The overall decline in healthcare private equity activity so far in 2024 was driven by a sharp decrease in add-ons. Nonetheless, add-ons comprise the biggest share, if not an outright majority, of all transaction types for most sectors, and are the key contributor behind PE activity, representing a higher share versus corporate buyers of overall M&A activity for the last 3+ years. Also of interest to note, almost every sector saw an increase in recaps in 2024, a trend I suspect will continue as the Fed lowers interest rates. Moving on to the next slide and looking at private equity pipeline data, the median number of deals PE firms saw, or logged more accurately, was 181 in Q3 2024, down significantly, over 24% from the prior quarter. It's also worth noting that Q3 2024 deal flow was down around 10% compared to Q3 2023, which is a more relevant comparison. These numbers are frankly a bit of a surprise for most people. That usual post-Labor Day deal flow surge wasn't as big as anticipated per the data, and is consistent with what we're hearing from our conversations with PE firms. It does point to a softer than usual Q4 in terms of closed deal activity, potentially reversing my earlier comment that if we have a strong Q4 of deal activity, which is usually the case, 2024 should be higher than 2023. So let's see what ends up happening. This low deal flow count for Q3 creates a little doubt or at least some mystery around the continuation of the last few quarters uptick in closed deal volume year over year. Moving on to the next slide. One of the things we're seeing both in the data as well as in our conversations with clients is quote unquote deal fatigue, where deal flow is up or steady, but quality is not great. Closing rates are down. As a matter of fact, according to a recent analysis we did, closing rates are down about 7% in the last 2 years. And the time it takes to close a deal is on the high side compared to historical averages. So it's easy to see how the combination of all these factors can lead to frustration for deal makers. And this slide allows us to hone in on the time to close trends specifically using our proprietary data. So let's start by looking at pre-COVID in 2029 in a quote-unquote normal market. The time it would take a deal to close, as measured by when a deal gets logged in PE firms' pipelines to when it closes, was around 210 days. The median went up significantly during COVID, only to drop dramatically in the deal rush of 2021, declining to as low as 181 days. And more recently, it's been at historical highs at around 225 to 230 days for almost a year and a half now. So the data definitely supports this deal fatigue we're hearing about from the PE and M&A world. Moving on to the next slide. Here we're showing the top 25 sell-side advisors active so far in the year for the first 3 quarters, further breaking down their deals by size range. Houlihan, who has the top spot, shout out to Michael, has a pretty well-balanced cross-section of different deal sizes that they've completed so far this year, followed by Jefferies, Piper, Goldman, and JP Morgan to round out the top 5. It's very interesting that 3 of the top 5 most active advisors, Jefferies, Goldman, and JP Morgan, are typically associated with larger deals. And a reminder that this chart is not on dollar volume of M&A activity, it's number of deals. So we're definitely seeing some solid activity in the upper end of the market, which might explain some of these excellent Wall Street earnings we've had from the big banks. And on the flip side, the firm's generational equity and benchmark really stand out on the lower end of the market for deals sub 50 million in EV. Moving on to the next slide. We recently released our 2024 Deal Origination Benchmark Report, which we refer to DOBR, for our clients. And what you see here is a very high-level summary snapshot of this year's result. But before we get to that, what is the DOBR? Well, we've been publishing it for over a decade now, and it's really evolved into an industry standard offering a detailed review on the effectiveness of a PE firm's deal sourcing. Answering questions like, hey, are we getting better or worse around deal sourcing? Are we top quartile? Do we need to cover more intermediaries? Are we seeing less deal flow than our peers? And of course, how can we better prioritize our time and efforts moving forward? So that's the DOBR. Now back to the summary page. One of the key metrics we use is market coverage, which is the share of relevant closed deals a PE firm sees that end up closing in its target market. This current analysis was derived from 176 PE firms that qualified for inclusion, broken out into 8 peer groups based on size and level of sector focus. And the way that this chart flows from left to right, generally speaking, is from larger to smaller funds, which is why you see coverage drop for firms focused on the lower end of the market towards the right. Now, the main takeaway here is that most firms are still missing a significant majority of the relevant deals they'd like to see. Moving on to our final slide, this is part of the report that a client would actually receive. It's one of several different slides and analysis they get as part of their customized Dober. The columns represent the number of deals that close by month in a client's target market per their specific investment criteria. So it's a great way to just know how is overall deal activity in their markets trending. Now, within the columns, the green section represents the seen portion of that month's closed deals. And the gray is what they didn't see, with the blue trend lines calculated as an LTM percentage of the relevant deals they saw. So in this made-up chart, we're happy to see that the market coverage for the client is steadily on the rise. The table at the bottom provides the actual numbers behind the visual so folks can dissect the stats month by month at a more granular level. As you can imagine, our relationship management teams are very active walking our clients through these annual results for key takeaways. And like I mentioned earlier, this is one of just various slides we put together. With that, I'd like to turn it back to our moderator, Mr. David Toll, and our panelists for our discussion and Q&A. Thanks very much.
Thank you, Nadim. Great data. And I've got a couple of quick follow-up questions for you, Nadim. If 30% is sort of median for market coverage for private equity firms out there, what are the best doing? Like, what's the top coverage percent you've seen out there?
Good question, Dave. Do you mind going back up one slide? We can actually look at the stats. It can vary pretty significantly. So on the upper end of the market, we're defining that as firms that focus on deals at least $250 million of enterprise value and greater. There's fewer transactions, fewer intermediaries active in that space. So you can see that the median is about 41%. And I think the best in class we've seen is around 60. Historically, it was 54% just in this last cycle. And then within the within the middle market and lower middle market categories, as you get more sector focused, market coverage can tend to be higher, although it's not always the case since there's fewer transactions. And then the most challenging and potentially most rewarding in terms of inefficiencies is on the lower end of the market, which we call focused on 10 to 50 million in EV. If you're seeing 20% of that market, you're just crushing it. You're among the best deal sourcers out there.
Okay, and Nadim, also going back to an earlier slide that showed a big drop in healthcare add-ons. Any explanation for that, or any of the other panelists? Like, why are we seeing such a drop in healthcare add-ons?
I personally don't have a view on that, David. It just put together the data and it really jumped out at me. But yeah, perhaps the panelists, maybe that's a good way to start the Q&A. Maybe the panelists can chime in on that.
I can take a stab at that, David, if you'd like.
Sure, thanks, Brian.
I think there was a chilling effect in the roll-up of physician practices that's happened over the last couple of years. And there's a couple of data points. There was an action brought by the federal government, the FTC, against a radiology platform owned by Welsh Carson in Texas. And I think people were seeing that there may be more antitrust movement in that. And so, like, you see those deals like where if a private equity firm buys a platform, they'll start ripping off add-on acquisitions that are really kind of like acqui-hires. You'll buy a small practice with a bunch of docs, but sometimes they'll buy them really small, 1 or 2 docs in a practice. So you can see big volumes, but not big dollars of transactions. But that market really cooled off in the last couple of years.
Okay, good insight there. Thank you, Brendan. And right before we get into the roundtable discussion portion of our program, I did want to kick things off with a polling question and take advantage of the fact that we have a large a large audience here today. So give me a moment just to tee this up. And the question for everyone is, how do you expect your firm's total number of platform deals closed this year to compare with last year, 2023? So let's see if I can get this going. So go ahead and make your selections. Your choices are down from last year, even with last year, up to 10% higher than last year, or more than 10% higher than last year. I'm going to give you another 5 seconds or so to weigh in. Okay, I've closed the poll and I'm going to share the results, which are interesting because Nadim, remember, was showing data that pointed to roughly a flat year. But the folks on the audience, in our audience, seem more optimistic that they'll have closed more platform deals by the end of this year than they did last year. Well over half say that, and really only a minority are going to be down from last year. So that's interesting. Let's try one more polling question. This has to do with basically the same question, but we're going to ask about add-ons. How do you expect your firm's total number of add-ons completed this year to compare with 2023? So go ahead and make your selections. Again, the choices are down from this year, even with this year, up to 10% higher than this year, or more than 10% higher than this year. Give you another couple of seconds to weigh in. Okay, so here are the results of that poll, and this is interesting. So whereas the majority thought that they'd close more platform companies this year than last year, the situation is reverse on the add-ons. 60% say that it'll either be down from this year or even with this year when it comes to add-on acquisitions. Okay, so with that as a backdrop, let's get into the discussion portion of our program. And I'm going to start with a question for all of our speakers. And Paul, will start with you on the deal sponsor side. What is the quantity and the quality of deal flow like out there right now, just as we speak?
Sure, David. I think I would definitely separate those two, quantity and quality. I think, given the fund size and where we invest in the services sector, which is, as I think everyone probably knows, the largest part of our economy, our Western economy. What it means is that there's probably simply 40,000 companies we could acquire. That by maybe not by size, but just by count. And so what it means is, so I include them in add-ons. So what it means is, from a count, activity has been relatively consistent. Looking at data in our CRM, augmented by all of the great inputs from SBS, we're sort of up 10% year over year, just companies that are coming in the top of the funnel. But probably most importantly, we're seeing a nice pickup of those businesses, both at the IOI and LOI stage. So at the indication of interest, we want to learn more, and then the LOI, we actually want to own the business. So I think we're seeing both count up a little bit, but then we're interested in buying more. But I would say I don't reflect that as quality. I actually reflect that as a market condition. I can wait for you to ask about the market to talk more about that.
Okay. And what's sticking with you, Paul? What's your outlook for 2025 in terms of deal flow, quantity, and quality?
I'm not telling. If I know that, then I have control over the universe. But no, but seriously, I think we'll continue to see a similar market condition to what we've been experiencing. I don't view it as I don't view, other than putting the election behind us, I don't view much changing in would be a slight improvement in interest rate environment, slight improvement in portfolio company performance, which will enable add-ons. Since we don't tend to buy a lot from sponsors, that their activity, which I imagine will pick up dramatically, is not going to be a big driver for us.
Okay, thanks, Paul. And let's turn to the investment bankers on our program. Start with you, Brendan. Quality and quantity of deal flow out there right now as we speak.
Sure thing. So through the prism of Capstone, I'd say there is a steady drumbeat of deal flow in the family and founder market that is largely that is not really that sensitive to the overall macro, and certainly not to the deal market. Those deals just sort of show up all the time because they're driven by family and retirement considerations and succession planning, things like that. In my universe, the sort of swing producer are the private equity mandates, and I can say, over the past year, deal flow from founders and families has been fine. Uneven quality. We've had some wonderful deals this year, and then some companies that we knew would have serious challenges going to market. The private equity sellers, that has still been slow, and I'm really curious to hear Michael's answer to that question, because his firm is an order of magnitude larger, and I think is much closer to the tip of the spear in that market than my firm.
Okay, well, let's turn to Michael then. Michael, what are you seeing right now in terms of quantity and quality of deal flow?
So I'll start by saying I'd say the overall market is somewhat mixed. I think there was this perspective and anticipation coming out of what many thought was pretty much an abysmal 2023, that the activity level, and just let's talk about activity level, would be materially higher in 2024, with a view that perhaps, and then there's this kind of optimism that coming out of the summer months, we might see a pickup, not similar to the post-COVID 2021 kind of year, but a material pickup, and that's kind of fell flat. So I'd say overall, yes, the number of deals are up from last year. I'd say the quality is mixed. There's only a handful of what we would say are A type assets, and a lot of other B minus C type assets in the marketplace right now. What I think is what I'd say is pretty interesting is, from a firm perspective, we are sitting on a record backlog. So as we look at 2025, the backlog is at an all-time high, where most of those are geared towards private equity and the larger platforms, and where we've been spending a lot of our time. And again, everybody's practice is a little different. What I can tell you, and similar to what Brendan was saying, was this year was a lot of founder-owned businesses, a lot of corporate carve-outs, and a lot of add-ons. Because I think from a sponsor perspective, they are just hesitant. They didn't want to be the first one going out in this market before the Fed rate cuts, before the election, to kind of take their quality assets and be the first one out to market there. Now, are there some very nice A-type assets trading? Yes, but I'd say, as it relates to the processes we're playing in as well, the deal processes, they're a lot thinner than they used to be. And I think a lot of sell-side investment bankers are hesitant to basically say, listen, we're kind of in processes right now where we're getting a handful of bids, but buyers are dropping out because they're really picking their spots. And we're working on deals that there is a buyer or two. There's not 5 or 6 that are basically spending an excessive amount of money post MP to try to get to a definitive agreement or LOI. So it's a pretty interesting market, but we're hopeful, based on what we see in our backlog for 2025, that activity level and quantity and quality level will increase.
Okay, very very interesting. And so both Brendan and Michael, as investment bankers, are saying it's been slow when it comes to private equity firms taking their companies to market to sell, especially A+ properties. So that leads me to Paul, and I want to ask you, Paul, as you look at your portfolio, how are you thinking about timing of selling some of your prized possessions there?
Yeah, I mean, I think as a traditional private equity fund, our alignment is with our limited partners, and that means that a significant part of we're investors alongside them, and so our ultimate capital gains will be on exit from our businesses, not from any cash flow being pulled out of the businesses. So what it means is, like them, we are sellers of everything we own at some point, and certainly market conditions play a part into general sort of our view on exiting, as well as great advisors like Michael and Brendan telling us what they think. I'll tell you, just as they said, there are places where we're hopeful and optimistic that we'll have near-term exits in the portfolio. Where we feel it's uncertain, just as they described it, we are waiting. We are waiting, and I think we don't have the urgency. We have the good fortune, as I think I mentioned, we raised our most recent fund in 2023. We will have invested by year end, hopefully a third of that fund. So we're sort of in this lucky and hopeful time in the market where we don't need to be returning capital to drive another fundraise, which is a natural occurrence within private equity. So I'm repeating what they said. A assets with lots of up and to the right activity in their numbers seem to be getting very good responses. Everything else, you're better off probably waiting for a more warm reception, better performance, and a more receptive market, which it sounds like these guys are hopeful will be next year.
Yeah, and to Paul's point, I mean, one of the things I didn't mention is, as I sit in industrials land, there are still a lot of companies that are just having bad years and not performing. And there are some subsectors within industrials, packaging, chemicals, that were subject to raw material commodity pricing pressures, to overstocking, and they're frankly just not hitting their numbers. So it's just, putting those deals on the sidelines for, at least, another 2 or 3 quarters.
Yeah. So okay. So it seems like market's kind of humming along at maybe a slow pace. Nothing in the near future that might change that. But I have to, of course, ask about the election and how that might impact the M&A market. Brendan, any thoughts? How depending on how the election goes?
So my personal opinion, not speaking for my firm, is that the occupant of the White House doesn't really affect the deal market or the economy nearly as much as the newspapers like to talk about. The one caveat I would add is that if there is a potential near-term change to the capital gains rate, we have seen the fear of that rate increase precipitate a lot of M&A activity in the past. The most recent example was in 2001 when President Biden came into the White House, talked about raising the cap gains rates, and like every family and entrepreneur-owned business that has low basis, like they all went to market. So they said, all right, we want to beat the tax cliff to market. Now, of course, the capital gains rate never ended up increasing because he had a unaccommodating legislative branch. But that is the one thing I would say is that if you get a candidate that wants to raise capital gains taxes and you have a legislative branch that will support that, then you could see a big surge in volume of people trying to beat that cliff.
Right. Okay. And let's turn to industry subsectors and where we're seeing hot activity and where we're seeing cool activity. Brendan, we're going to stick with you. From your perspective, what industries and subsectors are really heating up right now when it comes to deal flow?
Yeah. So I'll mention a couple that are going to be sort of obvious to the people in this call, and then maybe that a couple that are not. So in the last couple of years, anything in sort of mission critical industrial services, residential services, and other facility services has been white hot. And you've seen little subsectors that have gone, frankly, sort of berserk. Roofing, pest control, there's been a couple of others. That's sort of obvious. We talked about healthcare a little bit earlier, and that has been really slow at my firm for a bunch of different reasons. But we're starting to see some green shoots there. We just closed a really nice sterilization business, a company that cleans machines for drug discovery and labs, and have a pretty robust pipeline there. And I think there's some pent up demand. The last thing that I'll mention that may be a little less obvious to people is that probably our busiest team at the firm right now is our building products and construction services team, where we're seeing both product businesses as well as like contractors, project-based businesses in the market getting really good reception from a sponsor audience, which is a violent change from where when I started my career 20 years ago. I mean, the notion of selling a contract to a private equity firm was almost comical. And now you're seeing private equity firms snap up contractors every day. And I've talked to my peers in sponsor coverage and they've corroborated that. So again, love to hear Michael's perspective on that with a firm with a really powerful industrials practice.
Well, Brendan, I totally agree with Brendan. And I was going to say, even being the industrials guy, there are parts of my practice that cross over into services. And the services sector right now, exactly as Brendan was saying, white hot, on fire, no pun intended. But again, one of the hottest fields right now is, and has been for the last handful of years, is fire life safety businesses. There are a dozen plus platforms of significant scale. We're seeing that trickle over to something near and dear to my heart, which is kind of security products and installer integration businesses. So highly fragmented market, very regionalized, and these are businesses that are effectively service self-perform models, and they are going in and designing, implementing, and doing the installation as well as the change orders, break fixes around building automation and security systems, access control, physical security. There are certain end markets that are driving that, data centers obviously being one, healthcare being another, higher ed, where we're seeing continued investment to just keep schools safe. And then what was interesting, obviously, from Nadim's presentation is industrials is still very active and large, and that is correct. And I think when you look at what's going on in industrials, again, I see much more in the way of corporate divestitures and carve outs. Look at Carrier, for example. Carrier went through 3 or 4 transactions, all going either to strategics or private equity. So we're seeing a transformation from an industrials perspective of a lot of these portfolios. Carrier sold their access solutions business to Honeywell for about $3 billion, followed that up by the sale of their industrial fire portfolio for $1.5 billion to Sentinel Capital, and then rounded things off only a few weeks ago, selling their commercial and residential fire Kit to a subset of folks over at Hudson Advisors, Lone Star Funds for about $3 billion. So on the industrial side, what we've seen is a lot more activity, not so much geared on the private equity side, but really, corporate divestitures where sponsors are picking up pieces, and then that will ultimately lead to a trade in 2 to 4 years time on all of those new platforms in the market.
Okay, very interesting. So common theme seems to be companies providing mission critical services to businesses or residents, or fire and safety related services, must-have services. Paul, of course, you invest up and down the services market in lots of different areas of services. What are you seeing in terms of areas that are hot, areas that are cooling off right now?
Yeah, if anyone is old like me and still reads the paper, if you read the Friday of last week's Wall Street Journal article, there was a cover article about how the HVAC industry is up for consolidation.
And plumbers.
And plumbers, I'm proud to say,
Yeah.
Michael, and I'm sure Brandon they both know, we bought ours in 2012, so we appreciate the Journal calling the end of this market. That's nice of them to do that. Just kidding. I mean, I think we, it's, as services investors, it's sort of what we do and where we've been. I feel fortunate to be on the lower end of the market of this, because I do think all of the great consolidation going on we view that as incredible opportunity for us to build compelling assets that sometimes just don't exist in these small markets. In terms of sort of what we're seeing. We tend to be thematic, so I'm not going to give away our family jewels. We have no original ideas, but we try and go after areas that'll end up in the portfolio. We're late enough on something that is in that automation control space that I'll call Michael in about a week and a half and tell him about it. But what I call out thematically, which I think is would be useful for the sort of the attendees on this call is, one flip around, and Brendan sort of mentioned on the building product side, like why I had no idea people would do this. What we've experienced a little bit is, as service sector investors, there's one thing we care about more than market, than scale. We care about labor. And so we've really seen a pretty unique sort of secular shift in what we're interested in as investors. Where in 2012, we bought a business in the nuclear industry, so doing work for the highly regulated sector. And that business had a part of the business that was a staffing model. And I sort of held my nose and we did a deal. And because the world sort of said staffing, as part of a service model, right? Like service is higher value. But the need to get accesses to pockets of labor have really made that part of some of these business models actually as a virtue as opposed to a necessity. And so we've seen that shift in a number of the service models. Just if you can just get access to people, that's differentiated. Where before it was more about people view staffing as really a highly cyclical market. It's now become you need it always, because you always have staffing shortages in these skilled industries where you have a workforce retiring out of it. So that's one shift I'd say. The other is we made an investment in a company called Newbold Corporation, which does work for retailers. So where you buy that square hamburgers at Wendy's, you walk in, there is a use of technology everywhere, all over it. You're ordering on a screen, you're talking to AI at the drive-through. Well, there's no one inside the building that knows how to fix technology. And so they're doing that IT service work, that electrical work. They're doing it through a 1099 network. So we largely staff by outside subcontractors. So just sort of a different way to skin the cat, to use the metaphor, in services models is really, we're looking at that and trying to figure out where the next trend will be on this broad services sector.
Okay, thank you, Paul. Very interesting way of kind of perspective on the market, given the tight labor market that we're in. We do have a question from the audience, and maybe I'll ask Nadim. The question is how can a lower middle market private equity firm, a smaller private equity firm, increase their market coverage? So they obviously have a big challenge in light of the tables and charts you showed earlier, Nadim. Are there some, how do you tell those clients to get those percentages up?
Well, there's a lot of different ways to do it, and the answer is going to depend on, how many people do they have? Do they have a centralized business development team? How many people do they source? Like, what kind of investment or deployment pace do they want? All these things come into play, but I'll just mention one important differentiation when you're in the lower middle market. One of the things we've seen over the last few years on the part of sponsors and as well as with a handful of investment banks we work with is, the sponsor coverage model, the direct to sponsor sourcing, especially as these private equity assets continue to age longer than normal, there's going to be a buildup of this over time, and most of them are going to hire someone like Brendan or Michael to represent them. Almost all of them will. But for them to be able to dissect that market and stay in front of and kind of identify which ones they want to spend time with when they do come to market and not can be a strategic advantage. Now, that is completely irrelevant for the lower middle market firms like Paul, because they're not typically going to be buying from other private equity firms. So the thing in the lower middle market, and the reason that market coverage is so low, is that there's such a broad and ever-changing universe of intermediaries and deal sources that could bring you your next deal. So while we're a data and analytics company, and that's very important to know which ones are active in your space, get reminders when new ones come up, get reminders when there's some changes in trends of certain firms doing more or less in your space, which ones do broad processes, which ones do limited processes. This is all data intelligence that's going to direct your time more effectively. But at the end of the day, in this lower end of the market, relationships are really, really important.
Say, Nadim, we are getting an echo, so I'd like to ask speakers to go on mute if they're not speaking.
Hopefully, yeah, that's better. I'm not getting it anymore.
Okay.
So,
yeah,
and that it's especially in deal sourcing, relationship building is key, whether in person, through conferences, through calls, through reaching out via email. And it's a really, really important focus. I think we see the ones that are performing better from a market coverage standpoint and how they're increasing their share. It's just having people or resources dedicated to strengthening those relationships. Using data analytics, at the very best, we're a tool that's going to help you understand how to prioritize and form strong relationships. And so I think that's one of the keys in the lower end of the market.
Thanks, Nadim. And Nadim, another quick question for you, sort of on the definitional side. You showed how long it's taking deals to close, and the question is, what starts the clock on that time?
For that analysis, what starts the clock is the date seen that gets tagged in private equity firms' pipeline. So the date they logged the deal. So there's different ways to look. Maybe the more technical could be when the bank launched it, or when the bank, or when the seller hired the banker and made it official. Or there's different ways to do it. The important thing is to be consistent on how you do it, so you can see what the trends are looking like. So in our case, it's when they showed up in private equity firms' pipelines to when we have it as a closed deal in our database.
Okay, thank you, Nadim. And let's turn to Brendan. Brendan, I wonder if you would ground us a bit as we move into a discussion of purchase multiples and leverage multiples, just what you're seeing out there for a middle of the fairway sponsored deal that you're working on. What are you seeing in terms of purchase and leverage multiples?
Sure. So it's so asset and sector dependent, right? So to speak in generalities is like, it in my mind is sort of useless cocktail party prattle. What I can say is, because of the scarcity of, quote unquote, A assets, though, when those assets are going to market, they're getting absolutely A+ pricing. And that is, so I think there's, the need for the sponsors to deploy. So when they see something that's truly exceptional, they go to the mat and they're paying crazy prices. I mean, people are offering up their firstborn to get a management presentation, but a company that, has a visible flaw, I can't get a bid for 5 times, right? I mean, if people lined up to pay 20 for something, that's perceived to have a lot of tailwinds. And then, one other comment is just on the leverage. One thing, because nobody's mentioned credit here, and I'm not a credit expert, but I see how it manifests in the deals that I'm working on. If there's one big change from a year ago to today, it's that the credit markets have gone to being a headwind to a tailwind. The availability of credit, both from banks and the private credits, is extraordinary. And the lenders are doing sort of unnatural things, in my view, to deploy capital. The spreads have compressed by 100 basis points or more. Plus, we've gotten some rate relief, obviously, in the base rate from the Fed. So that is starting to manifest itself in a little bit of buoyancy in the multiples overall. Hopefully that answers your question.
Yes, absolutely. And Michael, I wonder if you would weigh in on this question as well, especially in light of how much money has been pouring into the private credit market, to the point where it's just absolutely exploded. Private credit has become an asset class unto its own. What impact is that having on the deal market and pricing and leverage multiples?
I'd say extremely favorable for us from an M&A perspective. It's another source of capital, kind of finance our deal that is outside of the traditional bank or syndicated, loan market. It's an asset class now in and of itself. There were some stats I was looking up that at the end of 2022, that private debt assets were in the range of 1.6 trillion, up 17% from the prior year. And it's been extremely beneficial from our processes. We actually have a dedicated group at Houlihan that effectively goes out and will advise and effectively run a M&A process on the financing side with direct lenders to get our clients the best pricing terms for their debt packages. And what I would say is private credit, the spreads are compressing. They provide effectively three great things to our deals. One is an increase in execution certainty. You don't have to go to the syndicated markets and effectively have a 30 to 90-day marketing period anymore. The terms of which you are financing now are usually set and dictated at signing, as opposed to post signing, and you have to go and syndicate, and there's flex provisions, so you're not really sure exactly where pricing and terms may come out. And I'd say lastly, portability. So the ability now to get a club of private lenders or even one lender and have the ability to kind of port a credit or financing over to effectively a new owner of a sponsor asset is incredibly powerful if you're either doing a deal or doing a refi. So it is the direct lenders are very much active in a source of LBO financing for a very good vast majority of all the deals that we're doing right now.
Paul, from your perspective,
David, if I could piggyback off one thing that Michael said, agree 100% with everything you just said, and I want to amplify one point, is that this private credit market is still the Wild West.
Yes.
It is not an efficient market. And so if I could particularly the sponsors on the phone, if you're calling 4 or 5 lenders and you're thinking you're getting a market read, you are wrong. And so, the debt placement group at Houlihan, we have one in my firm. I'm sure there's a dozen really good providers out there that'll run a proper process that is sized correctly, but it's labor intensive and you got to get out to all these guys fast. But the point I'm making is, like, if you've talked to 6 lenders, you've talked to 6 lenders, and you may need to talk to 60 in order to get the sort of the right market rate. And so I think people make the assumption this market is efficient, and it isn't.
Okay, very interesting. Paul, we have to get your perspective on the credit markets. How are you kind of taking advantage of what sounds like improving conditions in the credit markets, and what are you seeing?
Yeah, I mean, I think we view ourselves as sort of probably overstated relative value, sort of lighter growth investors as opposed to high growth investors. And so what it's meant now, before, hopefully in the future, our leverage buyouts are relatively moderate and leveraged, so not over levered. And so while absolutely these guys will get best execution, in reality, in any instance, I think they would get us a lower debt package in terms of cost. I think, you know, sometimes, and maybe it's just our conservative style, the deal you do on the front end will be very important if it doesn't go as planned. And so I think we've maybe given up a little economics to make sure that we have capital partners who we've been through. I'm gonna surprise everyone listening. It doesn't always go as planned, guys. And so you can absolutely price for perfection, and in processes that where we've had some of these great guys provide us support on a sale of our businesses, I sure as heck want them providing perfect execution. On the buy, we on the lower middle market, we'll lose sometimes because someone else will find the outlier lender, and that's the process that you know, unfortunately we these guys tell us about after the fact. But so I think, you know, they're absolutely saying it correct. You know, there is a broad market of availability, and to enable really good, really incredible pricing. As an institution, we have a bias towards, you know, finding, you know, holding these folks honest and I would guarantee the work of their colleagues would help with that process too, even if we choose the folks that we always choose. But I think we're probably we sort of stick to our, this, you know, call it the same 18, and that's served us well. But you know, we'll need to learn and change with this market, I'm sure, over time.
Okay, we've got about 10-15 minutes left in the program, so I want to make sure that if anybody has questions out there, that you use the question feature on the control panel to ask them now, and I'll keep an eye on those as they come in. In the meantime, I'd like to switch gears a little bit and talk about sort of the nuts and bolts of finding deals, and what are some of the techniques that are working on that front right now, and what's no longer working. And Paul, why don't as our deal sponsor, let's stick with you. And you know, you obviously on the services side, you're looking for family-owned businesses, entrepreneur-owned businesses. What's working when it comes to sourcing deals from those kinds of sellers?
David, patience is working. It's the stats that Nadim shared before. We'll get 4 deals done in the calendar year 24, which is I think is what an Everstat, and even across like the upper middle market, sort of high performing. Lots but it's not. It's a good piece of that is luck. 2 of those deals have been in the pipeline well longer. Nadim can look at the data. Well longer than that 230 days. So broken processes that came back to us where other buyers, whether they be strategic or other sponsors, had underwritten to a higher return, and ultimately a diligence fail or an investment committee challenge sort of made the deal come back to us. So I would say what we're finding is, sticking to our, having the courage of our convictions, leaning in everywhere we want, and where we don't, just making sure we represented ourselves well, we're forthright, honest participants, liked by the prospective seller and management team. So when they suffer a broken process, they feel like they can come back to us. So I think that's one pretty big trend. I'll tell you, I'll draw on luck as long as I can. Our fund 2 was a 2019 vintage. Fund 3, as I mentioned, is a 2023 vintage. Time will tell if we'll do well. It'll be a great vintage, 2023. People will look back 10 years from now at 2023 for, well, hopefully we'll be one of those funds. But it's just a good time to be buying. It's a good time to be active in a market where pricing, as by Nadim's stats, have come off. So we're leaning in everywhere we can, where we feel we like the business, because we know it's just, it's a market. It's not 2021. There is some fear on the sell side. Not these guys, but just sort of generally, everyone wants to get a deal done, and there's sort of a balance of power in terms of buyer and seller saying, hey, we can do this together, and get something done at a reasonably high price. But if you want perfection, it's probably something's going to change, it's going to break. And so this is markets where at least our investment committee, our investment style, time will tell if these are good choices, but it's been a good market, despite all of the sort of the headline, off the history.
Thank you, Paul. And Michael, you mentioned earlier that a lot of processes are thinner these days in terms of participants. How do firms make sure that they get invited into these processes, make it onto your radar? What's the secret?
David, I don't think there's really, obviously any secret, and I'll make a little change to my comments before. I'd say, we are in many instances still going out broad in our deals, because we're not sure who's going to do the deal. We usually have a pretty good sense of, the handful of buyers that will be highly interested in it, but ultimately, when we've got pretty good insight to a lot of funds, but we don't know exactly, the last deal that didn't go their way and a partner that's very aggressive. So what I'd say is we're still going out broad. I would say, to Brendan's point, the A++ assets are getting incredible pricing, mid-teens, 20+, 30, 40 type, IOI bids. If you have a blemish here or there, listen, you may go out and you'll get, 10 or 15 bids. People will take MPs, and the folks that are, taking those MPs, I'd say we're seeing a higher than average drop-off rate of they're taking a look, and then even after they've taken a look, they're saying, hey, you know what, not really for me. So I think the days of, we're not in the market right now where, you give 10 MPs and you may still have 6 or 7 people doing, full-blown diligence and submitting refresh bids and trying to fight for a seat at the table. And more likely than not, you're in a process where, there's an interested buyer and a backup, and you're kind of, dealing with, that kind of dynamic. From a deal sourcing perspective, I think it's all about continuing to kind of have the dialogue with the coverage, sponsor bankers at the firms like myself in mid markets, and also building relationships with the industry bankers, the guys like myself that are in charge of a practice and deal origination and execution, because ultimately I very much leverage the Brendans of the world and the guys that are within my sponsors group. But I also have a set of relationships of sponsors that I've known for 10 or 15 years, and I want to make sure that they're getting a look at my best assets.
Okay, and Brendan, same question for you. How do sponsors make sure that they stay on your radar, that they get invited to the processes that they want to?
Yeah. So there's no magic bullet. I think the firms that embrace origination as a center of excellence rather than just a role, they tend to excel in this department. And what do I mean by that? I think the private equity business development professional is a new profession in the last 15 years. That wasn't a job that sort of existed. And now there are hundreds, maybe thousands of these professionals running around the market looking for the deals. The firms that sort of tick the box with a hire and expect that, like, well, this one person is just going to run around to a bunch of conferences and they're going to fill up the pipeline is a little naive. So the firms that take like a whole firm approach where they have a dedicated business development function, but where all of the partners and all of the deal makers are supplementing that outreach both into the investment banking community as well as, potentially with direct outreach to company targets, those firms are ultimately going to win. And then the last thing I'd say is, there are firms that take a decidedly non-commercial approach to their deal sources, which I find totally mystifying. And I'm talking my own book here a little bit, but I know Michael will appreciate this. It's like, tip your bartenders, guys. And the firms that are figuring out ways to make sure that they are using their important sources of deal flow as service providers, that's you know, that's a huge piece of the consideration.
Okay, really good advice there. And we've got a question from the audience. And no webinar on deal sourcing would be complete without talking about artificial intelligence. Question is, are people having any success with deal sourcing with AI? And maybe I'll start with Paul, then we'll go to Nadim. Paul, are you using any of these advanced AI technologies in your deal sourcing, and if so, how?
I'm not on this call. I'm AI, so it's obviously working. No, I think we are using it on the analysis tool side, on the underwriting side. On the sourcing side, not so much. I think I think it's, if you want to call sort of efficient emailing AI, that's fine. I view this stuff as relatively, it's sort of kindergarten version of AI. So I have not seen it. I think it's primarily our great associates have been augmenting their analysis, and it doesn't replace reading materials yourself, but we've had some interesting discussions internally where specific associates have been assigned to sort of play with tools, and we've seen some very good sort of both understanding of the limitations of AI as it currently stands in commercial environments, as well as ways to sort of make their jobs where we saw in the last 12 months we saw 1,100 opportunities, I think I mentioned. So like there's ways to come at that and sort of make that process a bit more efficient, so that we can really focus our energies on the areas where we want to focus. But I would say it's less on outbound, less on sourcing, and more on analysis, underwriting.
Okay, thanks, Paul. So more on the due diligence side, less on deal sourcing. But Nadim, you're probably in the best position here to talk about how AI might impact the deal sourcing space over the next few years. What are you seeing?
I think it will, David. It's just a little early on. I am, both as a firm and as at a personal level, I am every week, every day, discovering new ways to use AI in different ways. Yesterday, someone I know sent me an AI-generated podcast with a man and a woman, 15-minute podcast that was just directed to a website, a somewhat complex website with different nuances and different pages, to just have a discussion of what they saw. I was completely blown away because I know some of the nuances that were on that website, and the fact that it could do that, just like, it was amazing. And so we're exploring it in our business, both on creating efficiencies, getting expanding our reach of data, saving costs, improving the data. And then we are also looking at, as a data company, we're well poised to use AI, like to create analysis faster, and that means more analysis and more takeaways and more insights that could give you an edge. So we're definitely exploring that. I do believe it's going to change things in so many ways in the years ahead, and it'll also impact deal sourcing. I have not heard a private equity firm story yet where they told me how they were using AI in deal sourcing, and I was like, wow, that's it. They figured it out. But I think it's going to come.
Okay, and we've got just about a minute left, so I want to give Paul, our deal sponsor, the last word on the program. And Paul, I wonder if you would just tell us briefly about a portfolio company, maybe one that's under the radar, maybe unsexy in the industry that they're playing in, but that you're just super excited about, and just a wonderful company that you own. That's
very unfair. I love all of my children deeply, and they're all incredibly special. I think one that's just fun, it's a fun company to mention in concept, is a company called Ice House America. So this is in the vended ice and water space. So if you've spent any time in the southern markets, in the southern tier, as they call it, the southern smile, there's a real water quality issue. These hurricanes have probably made it actually pretty significantly worse in terms of the water quality that's coming out of the taps. Just the water is treated both in taste and quality of the real risk. So what Ice House America does is it's a vended machine that sits at the front of either at the front of the Quickie Mart or 7-Eleven, your drive-through, where largely remember those services companies, largely home and commercial services businesses are pulling up, getting filtered water and filtered ice to provide to their workforces in the certainly increasing heat of the year. And so Ice House, that business works both. We have our own assets that are in the field and which we manage, as well as through great customers like Southwest Airlines. So when you get that ginger ale, Brendan, in your drink and on the Southwest flight, that's our ice. So enjoy it, please. Cheers. So that's a business which, again, is a service and a service model. There's software embedded in it. We're tracking, tracking obviously transactions, and it's doing self-repair. So using AI to do self-repair of the machine as they have issues or shortages of bags and the like. So it's a sort of a real upgrade from the history of Ready Ice, which is a manufacturing facility and a route. So we take the trucks out of it, we take the manufacturing out of it. These machines are creating their own ice and water and filtering the water at each site. So that's my story, and I'm sticking to it.
Okay, sounds like a great company, Ice House America. I'm going to keep my eye on it, and I want to thank everyone for attending today. We are out of time. I'd like to thank our sponsor, SBS by Bain & Company, for making the webinar possible and underwriting the cost. And finally, most importantly, I'd like to thank our speakers for doing a bang-up job with the program. Brendan Burke of Capstone Partners, Paul Lipson of Fort Point Capital, and Michael Morabito of Houlihan Lokey. Enjoy the rest of your day, everyone.
Thank you.
Thank you.
Take care.
Thanks, David.